First-time homebuyers cannot seem to catch a break in today's housing market. Monthly mortgage payments hit an all-time high as mortgage rates continue to rise. You can see this millennial couple here is pulling their hair out in frustration because the cost of home ownership has gone up so much that it has become very challenging to get involved in the market. There is a lot to unpack in today's video, so make sure that you stay till the end because we're going to reveal some very alarming trends that we are starting to see unfold in the housing market. Now, you may be wondering, why did I refer to that young couple as millennials? Well, according to the National Association of Realtors, this is the anatomy of a first-time buyer. We have the average age of 33 years old, which falls perfectly into the millennial category. They have an average household income of $86,500. They put 7% down and they're buying a median purchase price of $252,000. However, the unfortunate reality in today's market is that they have less income and less wealth than prior generations, relatively speaking, and the median home price today in the United States is sitting at $359,000, which is more than $100,000 more than what they typically pay for their first property. And on top of that, they're carrying debt levels that are higher. The average student loan balance for a millennial is $30,000. And this is not including any additional credit card debt or car payments. Now, of course, the higher mortgage rates are not helping first-time homebuyers at the moment. We have the average 30-year fixed sitting at 6.73%, which is bringing the average monthly payment on the median priced home to $2,563 per month, which is the highest amount ever recorded. Now, that's up roughly 29% year on year, which is already a significant jump, but look where we were just a couple short years ago in 2021 and 2020. In 2020 alone, the average mortgage payment was sitting at about $1,500. So it's gone up more than $1,000 here in just the last 3 years alone, which of course is putting more and more pressure on the first-time homebuyer, which means that we're starting to see homebuyer demand fall off a cliff. According to Redfin's Homebuyer Demand Index, we're down 27% year on year. And if we continue to see a decline from here, this will ultimately lead to less showings, less offers, and even less transactions that we're seeing right now. Now, Redfin came out with this really cool illustration of how much home you could afford based on where the mortgage rates were. This assumes a 20% down payment on a 30-year mortgage with a property tax rate of 1.25% and homeowners insurance of about 0.5% per year. So let's assume you have a $2,500 per month budget, and if interest rates are sitting at where they are today, at about 6.75%, you would be able to afford a purchase of $376,000. Now, if you go back about a year and a half when rates were sitting at about, let's say 3%, how much home could you afford at that time? With a 3.25% interest rate, you could purchase a home that's just over $500,000 and still maintain that same $2,500 per month payment. So in just about an 18-month period, the borrower who had a $2,500 per month budget went from being able to purchase a $500,000 house to about a $376,000 house, which is more than a 20% swing in purchase power. Now, the higher monthly payments are not only deterring potential home buyers, they're also deterring potential sellers because the sellers aren't willing to let go of the mortgages that they already have locked in on their property. And according to the Redfin Deputy Chief Economist Taylor Marr, all eyes are on inflation as it continues to have a huge impact on mortgage rates and the housing market. And then, of course, the Fed said that this week it may hike interest rates more than anticipated to combat persistent inflation. That news kept mortgage rates propped up, but next week's official February inflation reading could send them meaningfully up or down. He goes on to say that homebuyers and sellers are ultra sensitive to mortgage rate fluctuations right now, so rates starting to decline would likely bring some buyers and sellers back, and rates rising would push more away. And to his point, consumer price inflation is remaining stubbornly high at 6.41%. Meanwhile, the U.S. average hourly earnings increased 4.6% year over year in February. So wages are going up. However, this will be the 23rd consecutive month where inflation has outpaced the growth in wages. And when inflation outpaces your wages, it's a decline in the prosperity for the American worker. And it could be one of the reasons why the Fed raises rates higher than anticipated here at their next meeting. The unfortunate reality is that inflation is kind of like a hidden tax on our wealth. When the cost of goods and services rises faster than the wages that we have, then we're actually making less and less income, even if in nominal terms our wages are going up. As an example, let's say you make $100,000 at your job and you get a 3% 2% annual raise. Well, now on an annual basis, you make $103,000, which sounds great on paper. In nominal terms, your wages have gone up. But if the cost of everything that you purchase has gone up by 6.41%, then you're still losing to inflation. And if you want to take it a step further, you could probably argue that the numbers here are going to be adjusted or skewed, because many of us know that if we just go to the gas station or go to the restaurant or go to the grocery store, that inflation is probably overall significantly higher than what's reported here. In addition to that, US household net worth dropped 2.7% year on year in the fourth quarter of 2022. This is among one of the worst declines on record going back to the 1950s. And just a year earlier, we saw a 15.3% increase, which was among one of the strongest ever recorded. And that brings me to some of the alarming and surprising trends that I'm seeing unfold in housing right now. We have the median asking price sitting just over $386,000, which is up 1.2% year on year. Meanwhile, the median sales price is actually down 1.2% year on year, coming in at $352,000. So it's a $30,000 gap that they're bridging between where they're listing the property and then where they're actually selling. So there is still this interesting standoff between buyer and sellers at the moment. We're seeing the number of new listings hit the market. That's actually down 21.7% year on year. It's significantly lower than what we've seen over the last few years. So as we're coming into the spring, we have not really seen a major increase in the amount of inventory that we were really hoping. Now, overall inventory is sitting at about 3.2 months worth of supply. This is up year over year, but it's still significantly lower than pre-pandemic levels. So one of the biggest challenges and hurdles for first-time homebuyers today is that they're dealing with mortgage rates that are higher, they're still dealing with high prices, and on top of that, there's really low inventory. Meanwhile, the cost of goods and services are going up across the board, and the average first-time buyer is carrying higher debt levels than prior generations. And then another interesting detail that's beginning to unfold is that some of the major banks have net unrealized losses that are absolutely massive. What happens is these banks invest in treasuries, and as rates go down, the value of the treasuries with lower coupons go down. The banks are not forced to report the loss of investment value as they're classified as held to maturity, meaning these are assets that they are supposed to hold for a period of time. But in the event that they are forced to sell in order to raise liquidity, the treasuries are going to be worth pennies on the dollar. And this is what we just saw unfold with the Silicon Valley Bank. So I am not sure whether or not this is a major risk for these larger banks at the moment. But one thing that we do know is that when the risk for these financial institutions goes up, or the probability of recession goes up, banks tend to tighten their lending standards, which makes it more challenging for borrowers to secure credit. Now, this chart does not represent mortgage specifically, but you can see that lending standards are already starting to tighten across the boards amongst credit cards and commercial real estate. And one of the reasons why I mention this is because the Fed has indicated that they're going to stop or reduce the amount of mortgage-backed securities that they purchase, which means that if they are not the buyer, then mortgages will have to be funded by the private sector, and interest rates are likely to go up even further. Now, at the end of the day, the biggest challenge is affordability, which is a function of home price, interest rates, and wages. And in my view, something has got to give in order for us to come back down to a level where homes are more affordable. So either home prices are reduced, mortgage rates come back down, or we see wages go up, or the more likely scenario is that we see a combination of all three. What do you think is the more likely scenario? Please leave a comment below. Let me know what you think. But that is going to wrap up today's video. I hope you found the information useful. If you enjoyed the content, please consider hitting that like button, subscribing, and sharing this video. It really helps grow and promote the channel. Thank you so much. Take care.